Eric, you may proceed, please. Thank you.
Very good, Mr. Jones. Thank you very much. So first and foremost, I would also like to just echo my thanks. I thought that was a terrific panel. That,
Excuse me. The audience, please. You're drowning out our speaker.
Okay, anyway, as staff, we would very much like to recognize the panel that Robert Glazier just put together. That was a terrific discussion, I think, and I'm really pleased that took place. So the other thing I would like to do briefly is to recognize Ryan Ong and Tiffany Harder for the work that they have done in putting all the technology together for taking care of the meeting yesterday and today. So, please recognize the hard work that these folks have done. All right, now we start with the actual fun part of this entire ALM work, which is the infamous clicker exercise. What we're going to be asking you to do is express a preference, if you will, for what I would really identify as kind of a risk and return zone or space in relation to the potential candidate portfolios. What we would like to imply to you, though, is that the actual asset components and the mixes of, let's say, equities and fixed income and things like that are really of secondary importance right now. What we really want to focus on are the lines that identify the expected returns, the blended long-term return, and the expected volatility, and with it the implication for potential discount rates. Once we have identified the sort of zone that equates to the level of risk and return that you as board members prefer within the asset allocation mix, we'll then step into an exercise. We're going to ask a question about the whole issue of a margin attached to the discount rate. So we want to explicitly get your preference in that area. And then we're going to drop down through a review of all of the binding constraints that are driving some of these asset class representations. And to the extent that you as board members would like us to shift some of those binding constraints, what we'll do is collect that information along with the sort of risk and return zone that you think is most appropriate for the strategic asset allocation, and we'll go back and see if we can, in essence, build portfolios that satisfy both any changes to the constraints that you would like to make and also, again, that target risk and return zone and by implication sort of discount rate area. That'll be the work that we go back and do and we bring back to you at a future time point. Hopefully we'll be able to preview that with you in December, and then you can make a decision. If we move the decision point off to February, that's when an actual decision could be made. So it's most important that you think about, though, what we're really talking about is this sort of risk return volatility area less than the individual asset mixes at this moment. So I just want to make sure that you're focused on the area that we really need some feedback on at the moment. So I think with that, if we're ready to actually get started, are you ready, Tiffany, with the clicker exercise? So basically, what we would like you to do is identify, given the brackets, and I think everyone has received a handout at this point, so you have this material printed in front of you as far as which of the candidate portfolios we have listed. You can see that, in essence, these things are identified by their title. So we have the lower risk alternative, we have the lower risk, base case, and so on. We also have the current policy portfolio, and then we have a choice on other. And if the majority of members identified other, the plan is then to put up a schematic of the efficient frontier. I think, can we show that screen? We could put up this schematic of the efficient frontier that would allow you to express a preference for either a higher risk or a lower risk area on the efficient frontier. So these things don't necessarily have to be completely mutually exclusive, but we really want to understand, though, if we basically have bracketed this too much that you feel like you're being too hemmed in as to a space in the efficient frontier, if there's really an appetite for trying to push into some other part of the opportunity set. So we can sort of collect these pieces of information. They may to some extent seem a bit contradictory, but I think that that's the kind of feedback that we need to be able to really identify the alternatives that you would like to have brought back to you. So anyway, the first voting exercise, though, is again based on sort of the bracket Alan, sure, yeah. So based on the bracket, and we'll let Alan make a comment, I think, around the actuarial considerations.
Sure. I just want everybody to think, this really should be a single decision about what the risk levels you want to take in the funding of the system are, and not two decisions. So the next vote, presumably, will be whether or not you wish to have a margin for adverse deviation. Ideally, we would have liked to have had all of this put together in a single vote, so you had both the candidate portfolio and the asset allocation. Unfortunately, there are only 10 buttons on the clicker, and we would have needed more buttons. So we have broken this out into 2 votes. But when you're thinking about what is the candidate portfolio, you also need to be thinking about whether or not there should be a margin for adverse deviation, because those combined really kind of give you the risk characteristics you want to have. So it will be 2 separate votes, but it is, I think, very important to be thinking ahead to the next vote as well, because they both have a significant impact.
Okay, so before we actually start, Ben, I'm sorry, any other questions? Are there any questions or comments that anyone would like to make before we actually try to take a first pass at the vote? Dr. Deere?
On the current policy portfolio, I'm trying to figure out why somebody would want that, because because there's no, I don't know. I mean, it looks to me, it has for the same return, has a poorer risk than others. So does it get into the potential discount rate, because it would be 7.5 and the others are 7 or have a 0.25% margin in them? How do we interpret?
Maybe what I would do is ask Alan Milligan if he could comment, because it's sort of a bracketing exercise on return that then spins down into sort of the discount rate thing.
So, yeah, if you select the current policy portfolio, you can expect us to be asking you a lot of questions about why you chose that.
Okay,
because
it's off
it doesn't make, relative to the base case, you've got a very similar return with a significantly higher standard deviation.
It's off the efficient frontier.
It's off the efficient frontier.
Yes, so it's off the efficient frontier slightly, and we try to show it on the chart, but it doesn't show the way that it's off efficient frontier. But your observation is absolutely right.
Exactly. Are there other observations or questions? Okay, seeing none, I guess we would go to the first quicker exercise. Tiffany, or Ben, can we get that on the screen? And we would just ask you to make a vote on any of these categories, and then we'll see how that turns out. Okay, we get 10. 11. All right. Is it 11? Okay, so let's see. What we have identified then is 3 and 4, which is base case and higher return. Okay, there's an other.
One other, one lower.
Right, and then there's one lower. Would anyone who, this voting is anonymous, but to the extent that someone, for example, picked an other, we can go through the other exercise and see if people basically determine that they would really have an appetite for that. But if anyone would care to make a comment about that, that would also potentially be helpful. Ms. Mom?
So I'm the one who picked other, so I can understand why you might want to know what that's all about. I guess it really reflects that I would like to see a couple of other scenarios. It's not that I am certain that there's something else that I want, but there are other things I would like to explore, including one of the things we talked about yesterday was having a lower absolute return strategies allocation, but perhaps with some. So I would like to see that, I guess, is what
Okay.
I'm saying.
Basically, when we come back and we actually talk about the constraint set, that's another place for you to express that kind of a consideration. So the question, from my perspective, would be if is there a space, I mean, do you really desire a different sort of risk level and return level, right? Or is it more the mix of what is going in to make up that level, just as it's represented on the page? That's the real consternation.
Yeah, so I guess the return level I'm comfortable with. I would love to see a lower risk level in conjunction with that return level.
Okay.
If that's achievable, maybe it's not. Yeah.
Okay. So in essence, anyway, so we seem to be centering on sort of the base case to higher return. So it's sort of like trying to maintain the existing rate of return, kind of maintain the existing discount rate structure, at least not talking about the margin yet, would appear to be. Mr. Johansson?
Eric, have we done any work at looking at replacing private equity with simply taking a part of the equity, leveraging it up?
You know, in the risk factor work that Ben and his team have done, I think one of the priors, one of the beliefs that we had going into that work was that we would literally see private equity being represented as a levered version of public equities. The actual risk calculations, though, and the factor calculations do not support that prior belief. There actually appears to be a more unique characteristic to that. So we honestly don't, at this point, have an analytic support for simply replacing private equity with a geared or a levered public equity portfolio. But I think that, looking for alternatives on that space is probably a valid concept.
At some point, I would like to hear the discussion on why that doesn't work. I mean, what the unique characteristics you think are. It's probably not the time for it, but.
You're absolutely right. There have been a number of academic exercise understanding what the true return drivers of private equity is as a levered public equity or not. And so far the research we have seen, including our internal research, is inconclusive. And we'll be happy to come back to you to do a comprehensive review of the work that Arthur has done and what internal work we have done.
Thank you. Mr. Jones?
Yeah, Eric, on the, and Ben, on the best case, in fact, I think pre-alluded to the absolute return strategy. And if we take another round and say, well, we want that to go to zero, would that didn't automatically go up into global equity, and to what degree or effect did it have on the expected compounded return?
So what we can do at the end of all of this clicker exercise, so we sort of, let's say we're operating from either the base case or the higher return as kind of a bracket. We'll go down through the exercise on the various constraints that have been applied. And if it's a desire of the board, for example, to change, let's say, the constraint that has been applied to ARS and change that number, we can then have the ability to move that number around. It's not as elegant and it's not as precise as an optimization, but we can see what the effect on that is, so we'll be able to explore that. And I would suggest we do that after we get down through an understanding of the constraints and your appetite for those constraints or your desire to change them.
Okay.
So that'll be about the last exercise I think that we really have planned for today, Mr. Jones. Other comments, questions? Okay, so I think we've got what we need out of that slide. Tiffany, thank you. I think at this point we would just skip sort of the movement on the frontier. I think we have more or less a consensus around the bracket, so I don't think we really need to do that. So our next question that we would like to collect your feedback on is actually on this actuarial margin for adverse deviation. And I don't know, Alan, do you have any more you'd like to say about that?
No, I think probably the thing to do is say, assuming that we are looking at the base case or something very similar to the base case, I'm a little bit worried that if somebody was voting for a higher return, the higher return portfolio with a margin, for them to now vote for a margin would, I think, give us a very confusing picture. So I think assume that that the consensus of the board really was for something very close to the base case. Seemed like there was some desire for a higher return, but in giving us your vote on the discount rate margin, I think it would be best if it was done on the basis of the base case portfolio.
Mr.
Oh, yeah,
After you're finished.
sure. Alan, could you remind us again, because I thought the adverse deviation was embodied in our discussion of de-risking the portfolio. So,
Yes, we did, certainly the flexible de-risking, we talked a little bit about using the margin actually to accomplish the de-risking. What we're really talking about here today is not the de-risking, but rather what level of risk and return do you want to run forward with as, so staff will be coming back with a recommendation on both the asset allocation as well as the margin for adverse deviation that really kind of reflects the guidance that we get here today. And so, the adding flexible de-risking would be something that we would be looking at out beyond that. But this sort of sets the, doesn't actually set the base for what we go forward with. That'll actually happen in February. But certainly this will give staff guidance as to what to bring back in February. But if you were to select the higher risk portfolio with a 1/4% margin, you would actually end up with a 7.5% discount rate. Whereas if you select the base case with 0 margin, you would also end up at a 7.5%. If you were to select the base case with a 1/4% margin, you would end up at a 7.25% discount rate. Selecting the higher risk portfolio with no margin would give you a 7.75% discount rate. So in terms of us understanding what your direction is, it helps us a lot if you actually, regardless of what your initial vote was, give us this vote on the basis of the base case. So this would be, do you want a 7.25% margin, sorry, a 7.25% discount rate, which would be a vote for a 1/4% margin, or do you want a 7.5% discount rate, which would be a vote for no margin? And of course, shouldn't be voting on what discount rate you want, you should be voting on what risk characteristics you want, but those two are very much equivalent.
Well, rather than saying you should, why don't we just do base case without margin, then vote again and record those two? Because there may be people that think, well, I don't know, whatever, they can think any way they want. And because I think it's not inconsistent to say I want to be more aggressive in the investment, but I want to have the cushion. So anyway.
That's correct, and that's kind of a
So
little
since
bit of
we've
my confusion here.
narrowed down what people are interested in to those, pretty much those two, Priya will be forced to join the groups too.
So if I understand correctly,
excuse me, Ann had a comment, and I'm sorry, we kind of passed over it. Go ahead, Ann.
No, it's okay. Two things. One is, we don't use a margin now
Correct?
in our current calculation of discount rate. But I just wanted to say, I don't think we should be using the word voting, because we're not you guys aren't voting, and you're not making a decision today. And if someone comes in and out of the webcast,
Right.
they might get
I
confused.
apologize for that.
No, don't apologize. It's just,
It's a really good point.
I think it's
we should be
important
careful.
to repeat that statement, Eric, just
No, absolutely. Again, so
so that it's clear to the public out there on the webcast.
most certainly, exactly. The board is not voting and selecting a portfolio. It's simply indicating a preference zone to the staff for the future work that we'll do and bring back to the board for an actual vote. I think in February is our current time frame on that. So absolutely right. We should not use the word vote.
and just to recap what Dr. Deere just said, the recommendation here is that we do this vote twice. One vote is based on if you think it should be the base portfolio, do you want a margin or not? And then we wipe this out and do the vote again. If it's a high return portfolio, do you want a margin or not? Not voting, collecting.
Exactly.
Could you please express your soup preference?
Okay, are there other comments before we start, or we already started?
So we should.
It's already voted. That's okay. It's being voted right now.
Voting based on base portfolio.
Yeah, this,
being preferred.
Okay. All right, so basically what we're seeing is for the base case portfolio, no margin. Okay, Tiffany, can we clear it now? All right, and then for the higher return category, okay, so it's,
Same number.
yep. Okay. Excellent. All right, are there any questions or observations before we move on to a review of the constraints? All right, seeing none, can we, all right, so the slide that you see in front of you right now is a reflection of the yellow blocks represent the binding constraints that have impacted some of the candidate portfolios. So what we really like to do now is go through an exercise of understanding the board's either agreement with the constraint level where it was set or desire to potentially move the constraints away from that level and the direction and magnitude. So that'll become apparent when we actually put up the voting blocks. So I think we're going to go right down in order of the constraints. So I think the first one that we would see is what has been applied to private equity. So if you see what we have, we've identified, well, again, well, it doesn't matter, Ben.
The yellow base case.
Yeah. So basically, Mr. Jelensik.
From the discussion yesterday, 12% really was about all that could be put in without really diminishing the value of it. So voting for or not voting for a 16%, what would that mean? The lifting the constraint beyond that which is practical, I mean, what does it mean?
I think what that would really mean is that we probably have more education to do with you as a board and with ourselves as to actually what constitutes the elements that cause the belief to center around a 12% capacity, in contrast with potentially a desire to have more exposure. Whether that is completely doable or not is not clear. And I think that that's just a dialogue that we would have to have and see whether we can, further test the beliefs that have gone into establishment of those things. Mr. Emkin?
I think for you to go above what the staff is recommending, you would have to ask them to come back and say what vehicles or what structures would be necessary to do it in a prudent manner. And I don't know what those might be. There are other large institutions that have bigger allocations. You don't have the largest private equity portfolio in the world. I can't believe that anyone wants to do anything that's suboptimal. So there may well be room to move it, but your staff has given us a lot of thought, and they're not comfortable going much higher, so they'd have to go back to the drawing board, in my opinion.
Eric?
Mr. Jones? Oh, I'm sorry, Michael.
If I can add to that, I mean, last time in 2010 when you did this, you had a special function built into your asset allocation work. You had declining returns to scale. So as private equity allocations got higher and higher, the return premium would actually decrease to reflect the fact that at some infinite size, you cannot obtain superior returns. That has not been built into the model this time around. But if you are voting for 15 or 16%, thinking this is a great way to juice our returns to 8% or higher, we need to at least mentally consider that you will have that declining return to scale function, even if it's not included in the math this time around.
Yeah, that's absolutely right. Mr. Jelensik?
And Alan, who does have a bigger private equity portfolio? In terms of dollar amounts, not necessarily percents.
The percent's easy, I just have to go north. Mr. Deere is quite familiar with that. In terms of size, I think you'd have to go outside the United States to find a larger portfolio. You'd have to go to one of the sovereign wealth funds.
Okay, because, that's one of the, both advantages and disadvantages of size.
Right.
Yeah.
Other questions or comments before we get an indication as to your preference around this constraint? Mr. Joansick again?
No. Not yet.
Why don't we try taking a vote on this then? And as you see, number 6.
Preference click.
Yeah, I'm sorry. We're going to get an indication. Excellent. Okay, I think we have 11. Okay, so it appears we have a sort of consensus around the constraint where it exists, basically, with, with a desire to potentially try to bump it up or potentially a desire to move it way back. Would anyone care to speak to the really pushing private equity way back kind of a element? All right, that's fine. We don't have to call that out. All right, any comments, questions from what we see here? All right, fixed income. In fixed income, the constraint, again, applying to fixed income is the minimum amount of fixed income. The lower level constraint is the binding constraint in relation to fixed income. There's been discussion within the staff about trying to peg the level of fixed income at 18%. That was the recommendation that came out in some areas, but we may or may not be able to achieve the desired rate of return if we actually have that much fixed income. So why don't we work off the 15% number that is indicated right now. Mr. Joansick.
Can you give us some insight into the discussion about why staff thought maybe 18 rather than 15?
Sure. The discussion really revolves around having something that actually operates as a real hedge, especially in times of distress against the equity risk in the portfolio. And the only real hedge that we've had, or diversification that we've had, has been consistent with the fixed income portfolio. And the other element of this was, in our target allocation of fixed income right now is 16%. It is bumped up by 1% on an interim basis because of the interim target being applied to real estate. So 1% shifted from real estate to fixed income. But 16% is our underlying strategic target. It was also believed that if we reduce potentially the allocation to liquidity, that in order to avoid diminishing the amount of diversification that we have in the portfolio, that fixed income could potentially be a location for that other 2% reduction if that's decided upon from the liquidity allocation.
Thank you.
Are there other questions or comments? Okay, so we'd like to get your indication. Okay, so let's see. 6 is where we are, and then some desire to bump it. And that's actually a fairly strong desire to bump it. I think, what's the percent, Ben? Can you read that?
36 and 20. Oh no, and 18. 36 and 18.
Okay, so it's, yes, Alan, please.
I know it's a small amount, but the committee should really understand that that's going to be coming out of public equity, most likely, and there's a significant return difference, so that's going to reduce the return of the portfolio.
So I would want to point out that under the base case, we do have, I think it's an 18.5% allocation to fixed income. And so unless there are other changes, this constraint is not currently operating, nor would it operate at either the 17 or 18% level, which did have votes.
Yeah, thank you for that comment, Alan. That's exactly right.
Now, under the base case, the 6 for inflation assets, is that constrained or not? The question is whether more into fixed income might come out of inflation assets.
That's entirely a possibility. So why don't we so the indication would be for at least maintaining the constraint as it was at 15% and potentially allocating a couple of percent or so more into fixed income. So if we just hold that indication for the time being, I think then we can go through this exercise and see if we come up against something mutually exclusive. Okay, so we have that one, Tiffany. Okay, on real estate. And real estate, I'm sorry, was there another comment? On real estate, basically, we have put forward an allocation to real estate of 11%, which is 1% higher than its current sort of long-term strategic target, and it's 2% higher than the current interim target that the real estate team has been operating under as they have been restructuring their portfolio. So if we can get any questions or comments before we get an indication on this one? Mr. Johansson?
And this one is, it's the cap that is
It's the
current-
cap, it's the upside is the constraint, right? Mr. Jones, did you have
Yeah,
comments, sir?
if we were to take the real estate and the infrastructure and look at the asset class of real,
Of real?
then how does it compare? With the two things that are here, is it the same?
I believe in essence does it stay the same, Ben?
Yeah, so in combination stay the same. We bump up 1% allocation to real estate and down 1% to infrastructure.
Infrastructure.
So net is flat.
Okay, thanks.
Okay, are there other, Mr. Slayton?
So just to make sure I understand what I might be clicking on. Is the other one coming up? Is this driving infrastructure in forest land?
No. I believe that we have
So
those as.
it's counterintuitive. If this is going to affect the other, and then we're going to vote on the other, which is going to affect this. I'm
Yeah,
not quite sure.
I think
we're
you
gonna
should
click on it.
I think you should consider those to be independent elements
Okay.
that can be voted on independently.
Thank you.
Right. So for now, we're just collecting your feedback.
Indicated independently.
Yeah, we're collecting your indication on each one of the individual constraints, and toward the end, we'll put up the Excel worksheet to see if it's workable or not, because the sum has to be exactly 100%, cannot be lower, cannot be higher. So we may not be able to accommodate all the constraints or preferences you are indicating, but for now, let's gather all the individual, your feedback on the individual constraints, and then toward the end, we'll work it together.
So, but with leverage, you could be over 100%.
That's another policy question.
Okay, other questions or comments before we indicate on real estate? Yep,
And Bill?
excellent. Okay, so there seems to be a decided preference for staying pretty much where where it's been pegged, maybe a slight bump to the upside, which. Yes, sir.
It's important also to keep in mind that just saying the target doesn't limit the range, and there'll be a range around every target, so if there are opportunities or disadvantages, it can be higher or lower depending upon what the market dictates.
Absolutely. That's a great point, Alan. Thank you for that. Okay, let's go on to the next category, which is the infrastructure forest land. And again, this is set at 2%. I think that is pretty much exactly where we are currently operating under an interim target for infrastructure. The original target for infrastructure was bumped up to 2% to infrastructure, 1% to forest land, but it has been operating under a constraint for, as they try to work into that program. Okay, we've got 11. All right, so let's see. So 3 is, okay, so the indication on infrastructure forest land centers on the maintenance around 2 with a directionality to increasing it.
Eric,
Mr. Jones?
how much of infrastructure that is uncommitted currently? Maybe that's a Ted question.
I think our current uncommitted on infrastructure is about $500 million. I want to say about 500 million.
In terms of
Joe's
uncommitted
got the information, I
commitments?
Yes.
Yeah, it's about $500 million.
Oh, okay, it's a low number. Okay, thanks.
It's a Harvard. 440? 440.
Are there other comments or questions before we move on? All right. Inflation assets.
Is there a constraint Or what is it here? It says,
It's
do you
the
want
binding
more or
constraint.
less inflation
And
assets?
that's going to be it.
Yeah, so the 6% is the bending constraint.
And that's a lower constraint or an upper constraint?
The cap, the cap.
It's a cap.
Yeah.
What is it about this asset class that leads the 6 cap to being a constraint? Why does the optimizer want to put more into it?
So currently for the very good question, is the correlation with the other asset classes tend to be on the lower end. So that's why the optimizer likes inflation asset class.
So it's the low correlation.
Low correlation, exactly. And as you may recall, we have an inflation asset class bucket for inflation protection purpose. So 3 quarters that invested in global linkers and tips, U.S. tips, and one quarter of that invested in commodities. Yes, Dr. Ms.
Excuse me, thank you. Sort of a question I have is that, it's on, sorry. Question I have is that if your expectations, let's say, over the next 3 years are that inflation is not going to be a significant factor, that would somewhat influence or reduce your desire to have a high cap in
Correct.
this analysis, I would assume.
So I would argue that would be a tactical move and not a strategic move, and that would be a bet that the staff would make, that within the range, they would be at the lower end of the range, as opposed to you, as a matter of policy, long-term policy, would say you want to change that. And that's really a question of whether that's a board strategic decision or it's staff tactical
But
decision.
I thought that the caps, whether they're upper bounds or lower bounds, are policy.
That's the policy, but the staff has discretion, and you can set the range. You
Right.
could have a wider range if you wanted them to have more
Right.
discretion.
That's true.
I just would also point out that there's another constraint in the investment policy statement, which is the total fund tracking error limit, which is, I think, 1.5%, up to half of which can come from asset class deviations. So even if there is some sense on the staff that they really need to be tactical and protect against inflation, that may become a binding constraint even within the range. So if the target is 6%, but they can go 2 to 10, they may not be able to go to 10 because it may introduce too much tracking error into the total fund. So we may want to, after all of this, discuss ranges and that total fund tracking error to allow for whatever level of flexibility the board would like to see staff have.
Yeah, that's an excellent comment, Andrew. I would also point out, though, that the correlation assumed on the inflation assets is 0.03. So any reduction in that is going to, in essence, drive up the volatility of the resulting mix to some extent. This is one of the most diversifying components within the program. The only thing with a lower correlation is the liquidity area, which we assume is 0 correlation. Everything beyond that, though, moves up into sort of the 0.2 range on up from there. So reducing the inflation assets would potentially have an impact on the overall risk, but we can explore that afterwards.
Well, we've got 9 people who have expressed a preference.
Yep. Okay, we need one more indication. Okay, I think we're there. All right, so. Okay, so basically, the indication then has been just pointed out on inflation assets is the same with movement towards reduction. All right. Can we move on to our next category, Tiffany? Okay, this is liquidity. So there's been a fair amount of discussion about liquidity. We've put forward a 2%. Mr. McGuire. Excellent.
I couldn't pass on the opportunity. I'd like to comment that I'm somewhat uncomfortable voting even on this without having
Indicating.
clicking. I'm uncomfortable clicking until we get more information from staff relative to the December meeting, because we may find out relative to the discussion, there are significant opportunities for liquidity that we haven't been focused on within the existing portfolio. Therefore, there's potential that the target for asset allocation could be zero. So I really feel that constraint of 2% is potentially too high, and so I'm uncomfortable voting on that at this time.
Okay, so taking exactly that comment, I think that we can commit to bringing back information to you during the December Investment Committee meeting on those aspects in the portfolio where liquidity can be raised. Perhaps if today we can just get an indication, and then depending on, where we end up with the material that we put in front of you in December, then to some extent we can modify what we ultimately end up bringing back in February if it's warranted. Excellent, thank you. Okay, so the fair consensus around the 2% with, again, an indication to reduction would be the directionality, I think, if we were going to change it. Is there agreement on that indication? Perfect. Okay, let's go to our last category, ARS, one of our favorite topics of discussion. Are there comments or questions before we obtain your indication on this? This is basically a fixed number. It's been pegged at 2%. ARS is an area, I think, that you can expand or you can contract. In essence, it's not necessarily capacity constrained, I think, at the levels that we're talking about. This is one of the benefits of ARS.
This is the upper constraint, and it has been the case that whatever the upper constraint is in the optimization has been selected. Is that correct?
Well, this is just a peg number. If we unconstrain the optimization, as I said, the more we unconstrain it, if basically ARS would take an allocation, and it basically takes that allocation from fixed income. So if you unconstrain fixed income and you unconstrain ARS, you will see money directionally move because of basically the risk profile. And that should not, though, invalidate Curtis's comments basically about fixed income. We think is in a real adverse event, we think fixed income is probably a better diversifier to equity risk. So we definitely don't want to minimize that comment. But so basically it's the interaction of two constraints, Andrew, that determine that. But the higher return to ARS relative to still about a 7% volatility estimate, albeit the correlation on ARS is higher, it still pulls money out from fixed income if you unconstrain that. Mr. Jelensik.
So if I understood you correctly, the ARS is in some ways a fixed income substitute. In a normal environment, it provides somewhat better diversification than fixed income. In a stressed environment, it provides less diversification than fixed income.
I don't think we would assume that it provides more diversification in almost any environment. What it really provides, though, is a significant uptick in the expected return and not a real shift in the volatility. The correlation that we assume for ARS is 0.5 with the equity market. The correlation that we assume for fixed income is basically 0.21. So fixed income is believed to be a more diversifying asset, albeit you give up the return. And I think Curtis had a comment.
The other part of it is that fixed income expected return uses market yields today. And remember, hedge funds use expectational returns, what we expect it. So we're expecting it to yield T-bills plus 5. That, I think, is a case that needs to be played out. And so that's why the difference is, and the same thing that drives tips. Look at what the expectational return differences are, 50 basis points. A lot of this gets driven in the optimizer because of expectational returns of something, whether that plays out. And I think Wilshire says that for bonds using the 10-year return, you have a higher probability of achieving that over the 10 years than you do on expectational returns.
Yes, I think that's a fair comment. Michael, do you have something you wanted to add? Or Mr. Jones?
Yeah, if we were to make this 0,
Yes, sir.
that doesn't mean that we still cannot have a strategy in the hedge fund area.
That's exactly correct. That's the confusion that I think I created yesterday,
Yeah.
basically. That is absolutely right.
So when will we address that second part of that issue?
That can be addressed really at almost any time point. What we're really trying to get an indication of today is whether or not you really want ARS incorporated as a separate strategic component of the overall fund benchmark. And I think the issue as to whether or not you participate in hedge funds is a question that we don't have to necessarily answer today. We can bring that back. And that question has been explored to a fair amount over the last year, and probably more than that, the last several years. And again, I think it's still a bit inconclusive. But I think that, we should just take the indication that we get today and then think about how we would move forward.
The benchmark for ARS T-bills plus 5 is very challenging in a low interest rate environment. When we get to a more normal or a yield curve which is not subject to as much central bank manipulation, perhaps the interest rate will be higher and that target will be easier to hit. As Eric indicated, if the committee's decision is not to do hedge funds, staff won't do hedge funds. If the intent expressed here is 0, but go ahead and do an overlay and do it as you did before, that's certainly feasible. I just want to emphasize one other issue I think that's important. Because there's a belief, if you use hedge funds, that active management has a return, that active managers possess knowledge and skill which can be applied, and in the case of hedge funds, broadly across all asset classes, that some firms are there who can get that return, and secondly, that this staff can find them and do business with them. If you don't have that belief, then you shouldn't be doing SOL. And finally, we have not emphasized return increase for hedge funds for ARS, but rather risk diversification away from growth risk. And that's why Eric says think of it as a substitute for fixed income. And why Curtis would say think of it as an expensive substitute for fixed income. But I do want, just so you know, I think to say, well, there's a whole class of managers because of the publicity of the industry and the compensation scheme they use, we don't want to do business with them. I just don't know. I mean, there's smart people in the industry, and some of them do get paid as hedge fund managers. And the second thing is, Ed Robertello is building a team, and we've invested in that. And to go to 0 is to tell them we don't need you, and they'll go because it's a good team. And I would also admit, case is not proved whether we can diversify risk, whether we do select managers. The recent performance shows that, but we haven't proved it to my satisfaction, to the satisfaction of the team. But I just want those elements. It's active management. Do you believe in that? It's risk diversifying, and there's some people who work here who will take your signal really seriously.
Ms. Malvin.
Can you just remind me how much of the total, as a percent of the total fund we have allocated to hedge funds right now? Obviously, it's not allocated by the board, but by the staff.
It's almost exactly the 2%
It's at the
number
2%.
that you see in front of you, that basically is maintaining the status quo.
And
Yeah, and it's this, we took half the overlay off, so 1% off, so we have another 1% to go to make it an actual asset allocation. So we're very close to that.
And I know it's hard to predict, but how long do you think you need to prove the case? And obviously, it depends on what happens in the markets, and obviously, we would like to see how it performs in both good and bad markets, I suppose, but.
Yeah, we need a down market, we need another down market.
I don't want, I'm
Like
not
a
wishing
hole
for a
in the
down
head.
market.
For certain proofs of active management's value, a full market cycle is required. How's that for a more bureaucratic answer?
Yeah, we hope we never prove it.
Yeah. And how long has this asset been in operation, the hedge fund? The absolute
We've had a
return-
hedge fund program for 11 years.
The absolute return
Yeah.
strategy for 11 years?
Yeah.
But how long has it been since we established this class?
You basically, in February, decided the policy and strategy, February this year.
Okay.
And I think that was enormously clarifying that discussion, and that was, again, the risk diversifying, and then make it an asset allocation so that the board is in control of that rather than the staff, because we could go from 2 to 10, just, buy more equity futures. There is a limit, there are limits, it's not completely unconstrained, but.
Mr. Johnson, the ARS allocation has never been part of the strategic asset allocation until this moment in time, though. So it has never been incorporated in the ALM work up until this time point. Are there other questions or comments? Everybody's waiting, exactly. Okay, so basically, interesting. It's a fair amount of, so we obviously have a central tendency around the sort of 2%, 1% number, and then we have a significant dispersion from that point forward. Okay. All right, do we need anything else on that then, Ben? All right, I think basically if we could take maybe just a couple of minute break at this point, we can collate a bit of this information, and then we can put up the, I'm sorry, Ms. Mather?
I'm so sorry. I'm back at the margin question that was earlier. So clearly there was a preference for a 7.5% return or discount rate, but I'm really interested to know which option reduces volatility more, the base case with no margin or the higher end with margin. 'Cause I think it would be useful to be able to express a preference between those two options.
Okay. I think Alan has a response to that.
The margin doesn't, thank you. But in terms of riskiness for us, like which actually protects us more in terms of our ability to manage contribution rates, et cetera?
One point that I would make, if you look at back to the sheet that has all the candidate portfolios listed, if you simply look down between the base case and the higher return, there's a 25 basis point difference in return, and yet there's nearly 100 basis point difference in risk. So this is this sort of 4-to-1 trade-off where you're increasing risk by 4 units for every unit of excess return that you pick up. So there is not a lot of room to maintain, and you can see what drives that. It's a much higher allocation. If we stop out private equity at sort of the 12% number, you then basically have to use public equities as the return generator to do that, because every other asset segment has an expected rate of return lower.
So there's actually a graph on attachment 6, page 17. I don't know what not having my iPad up, I don't know what it is on the iPad. actually attached, pages 17 through 22, the middle of the three graphs. If you compare the base case with no margin with the higher return with a 1/4% margin, you'll see that the base case with no margin, at least for the state miscellaneous, has less risk of volatility.
Okay, thank you.
And I believe that's consistent through all of the different plans we looked at.
That's really helpful, thank you.
Yeah, thank you, Alan. Are there other comments before we can go back, and then we'll bring back up the worksheet where we can sort of manipulate some of these constraints and see the effects in a few minutes. All right, perfect.